This is a brief overview of Unit 15, Valuation of Businesses. Looking at Learning Outcome 1, we're looking at the different types of valuations and the purpose of these valuations. There's some reasons why a valuation might be undertaken. These include buying a business, raising finance, evaluating whether or not we want to buy an equity investment, and there are a whole variety of other reasons why we would want business valued. You might have heard the term due diligence. Due diligence is the process through which the purchaser validates representations made by the seller. There are basically three types or three approaches to valuing businesses. The first one is the income-based approach, where we look at forecasting future cash flows and then discounting them. So we're really looking at what are the future cash flows the business will generate and what are they worth today. The second approach is the market-based approach to valuing businesses. And here we're really just benchmarking the business we're valuing against other quoted organizations to which we have the value. The third approach is the cost-based. And this really is where we perhaps are liquidating a business. So we take all the assets on the balance sheet and we adjust them for either replacement value or liquidation value. Here we're looking at the relevance of the different approaches. So if we're looking to buy a business, probably the most relevant approach is the income-based. We want to know what are the future cash flows which will be generated by the business. The next situation is perhaps we getting rid of a business or part of an organization. And let's say the business is underperforming and we want to sell it in order to get cash so that we can use the money elsewhere. What approaches do we use? We'll probably use two approaches. Firstly, cost-based, to see what is the minimum amount we're prepared to accept for the business or the division. And we'll also look at the income-based approach to see if that will justify a higher price. When we're raising finance, the bank would probably want to look at the cost-based approach in order to make sure we got assets that could be available for security. They certainly would also take the income-based approach to make sure that we can service the debt. If we're thinking of buying, selling, or holding onto shares, we might look at the market-based valuation, which will give us an idea of whether these shares are good value. With an IPO, initial public offering, where we are raising money from the market, we would look certainly at market-based valuation to figure out how much we can raise. And we would also look at income-based approaches, and especially people who are wanting to take part in the IPO, invest their money, because they want to look at the sustainability of cash flows going forward. Learning Outcome 2 looks at the three approaches to valuation: income, market-based, and cost valuation methods, and looks at their strengths and weaknesses. So here's a table looking at the technique. For example, that's income-based, strengths, weaknesses, and where the income-based valuation method is most applicable. Similarly, we have the same approaches for market-based and cost-based. Remember that business valuation is not a precise science, hence often a range of values is calculated. So the person valuing a business might say, for example, that the business is worth between $8 and $11 million. What this does is it does allow for scope for negotiation between buying and selling parties. End of the day, the valuation technique provides guidance as to an acceptable range of valuation. It doesn't actually set the purchase or selling price. Learning Outcome 3 looks at preparing valuations using both the income and market-based approaches. Income-based valuations, as we've said before, use the discounted cash flow method. What we do is we estimate the future cash flows that a business will generate. The future cash flows are those cash flows which are available to investors, to the holders of equity, or possibly the holders of debt as well. And then we adjust these cash flows for risk by using an appropriate discount factor. Remember, there's always subjectivity with determining future cash flows, and the higher the degree of confidence we have about those future cash flows, the more accurate will be the valuation. Now, when using the income approach to value a business, we can either use the enterprise approach, where we look at free cash flows available to both shareholders and providers of finance. We then apply WACC to the free cash flow in order to get the enterprise value. That's the value of the whole business. Then we subtract the value of debt in order to get the value of equity. This is the most common or popular approach, is the enterprise approach, when we're using the income-based valuation method. And secondly, we could use the equity approach, and we start off with cash flows related to equity, which is effectively the key free cash flows less any interest costs. We then discount that using the cost of equity in order to obtain the equity value. Now, in theory, the two equity values should be the same. Here we have a definition of free cash flow. It's the cash available to pay returns to both debt and equity providers. This table here gives an example of how free cash flow would be calculated. It includes investment in fixed assets or sale of fixed assets, as well as increases and decreases in working capital. Now, we have a term called the forecast period or the explicit forecast period. And this is the period within which we have reasonable certainty as to future cash flows. A purchaser would tend to place less value on cash flows beyond the explicit forecast period. So we firstly need to define what the forecast period will be. It could be anything from 1 year to up to 10 years. Then we might have what's called a fade period, and finally a continued period into infinity with a constant growth. So there the graph here shows the explicit forecast period. Cash is starting to go down, and then slowly we're going down to our cost of capital over there. Now, in order to estimate cash flows in the fade and continuing periods, per that previous table we saw, we have what's called the terminal value. So it effectively represents future cash flows beyond the explicit forecast period, and we calculate the terminal value using a constant growth rate. Formula for the terminal value is over here. There are some examples for you to work through to practice calculating the terminal value within worked example 15.1 as well as activity 15.1. So once cash flows have been calculated for the explicit forecast period, as well as the cash flow for the fade and continuing periods, which is called the terminal value, these are discounted to get the valuation of the business. Let's now look at market-based valuations. So what we do is we're looking at similar businesses to see what they are worth in order to value our particular business. So step number one is we identify comparable assets and their market value. Then we find a standardized statistic, or what we call a valuation multiplier. We'll look at an example of them now. And we then apply this multiplier to the asset or the business being valued. There's a definition here for what multipliers are, and here's an example. So let's say there's a business, it's listed on the stock exchange, and the market capitalization, that is the total value of the shares being traded, is 64 million. Now, the current year's earning is 10 million. So the earnings multiple will be 6.4, which is $64 million, which is the capitalization, market capitalization, divided by the current year's earnings. So if the business we are trying to value has current year's earnings of, say, $5 million, and it's in the same sector, and it's very, very similar to this business here, which we can see in the example, we would take the current year's earnings of $5 million of the business which we are valuing, and we would apply the earnings multiple of 6.4 to the 5 million, which would give us a valuation of our business that would come to 32 million. There are two main multiplier-based approaches we're going to look over here. One is the price-earnings ratio. So that's the share price, the current market price of the share, divided by the earnings per share. The second one we'll look at is the enterprise value, the value of the business as a whole, the market value of it, divided by earnings before interest, tax, depreciation, and amortization. Each of those will provide us with an earnings multiple, which we could then use to value business. Here is an example where we use the equity value, where we're determining the equity value using the price earnings ratio. And secondly, an example where we're determining the enterprise value using the enterprise value divided by EBITDA. Here is an example of a cost-based valuation where we are adjusting the value used on the balance sheet to take into account the current market value of those particular assets. Learning outcome 4 looks at evaluating the impact of size, control, marketability, and liquidity on the valuation of a business. First, we look at the impact of business size. Generally speaking, investors in smaller businesses would demand a higher return to compensate them for what they believe is extra risk with owning a smaller business. With regard to a controlling interest, generally speaking, an interest that does not confer controlling rights is less valuable than an interest that does. And finally, we look at the impact on marketability. Quoted company investments are typically more marketable than non-quoted company investments, as it's much easier to sell your shares if they are listed. That's all for now. I'd suggest you have a look at your worked examples and activities. There's, I think, two worked examples in this unit, as well as 2 activities for you. Thank you.